Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. We are entering into week 7 today, which is fantastic. We are almost complete with our course. We have week 7 and week 8 remaining. This week we'll be discussing standard costs and capital budgeting analysis. And I want to bring your attention to a couple of items for this week. And of course, I'll remind you of this as we end the session as well. For week 7, very busy week. Very busy week indeed. What do we got going on in week 7? We have a decision-making incremental analysis discussion, your report for the 10K project is due. Your final presentation for the 10K project is due. We have exam 3 this week. We have a homework assignment and your week 7 report. That's a lot. It's a very, very, very busy week. In fact, this is the busiest week of our course. So it's essential that you get started as soon as you possibly can in the submission process. I recommend that you wait to complete exam 3 until you have completed homework 7. Wait to complete exam 3 until after you have completed homework 7. That will certainly help you because on exam 3, there are some standard cost and decision-making questions on exam 3. So I strongly, strongly recommend that you wait until closer to the end of the week to complete exam 3. And that hopefully that little tip will help, right? Okay, let's go ahead and jump into the content. And as you always, if you have any questions, please feel free to unmute your mic and ask your question. If you think of a question afterward, please feel free to call me, email me, set up office hours, whatever you like. I am around. Okay, let's talk about standard costs. Standard costs are costs that are standard in the business and are used to set performance goals. Standard in the business and are used to set performance goals. In manufacturing, we know that a product is made of direct materials, direct labor, and factory overhead. Direct materials, direct labor, and factory overhead are considered to be standard costs because they are costs that we incur standardly, if you will. That we incur them on a regular basis, and we can set budgets that we learned about last week. We can set budgets as they relate to things like direct materials, direct labor, factory overhead. How do we do this? How do we standardize our costs? We use an accounting system that uses standards for product costs. An accounting system, as you know, is a database used for accounting. An example of that would be QuickBooks. Another example of that would be Sage. Another example would be M3. An example would be, you name it, right? There's a bunch of accounting software systems out there. And they are designed to help management costs, keep their costs organized. They also help us to identify standard costs. How much a product should cost is a standard cost. How do we figure out how much a product should cost? We identify direct materials, direct labor, factory overhead that are attributed to the manufacturing of a product, and we need to cover those costs. And the system should also tell us how much the product actually costs. Think of it from the perspective of when we discussed budgeting concepts. You have your actual and your goal or your budget. We know that the actual costs are going to be different than the budgeted costs. And you can think of standard costs as being that budget and then the actual performance. And there's a comparison between the two. When actual costs are compared with the standard costs, there is what we call a variance, which is reported. A variance is simply the difference between standard costs and actual costs. And variances are reported to help management identify the variance and make corrections to the variance. In setting standard costs, accountants, engineers, and other management personnel identify what the standard costs are. Accountants convert results of judgments and processes, studies into dollars and cents. That makes sense. That's typically what accountants do. Engineers assist in the operation of setting standard costs by identifying labors, materials, and machine requirements in the production process. And other management personnel help in setting standard costs by identifying things like factory overhead, indirect labor, indirect materials, these types of things, right? All of these components help us as managers to set standard costs. In management, we have a couple of ideals, theories. We also have ideal standards. There's standards that can be achieved only under perfect operating conditions, such as no idle time, no machine breakdowns, no spoilage. Wouldn't that be nice if the real world worked that way? We know it doesn't, but running in an ideal situation helps management to set standards, because these things like breakdowns and idle time and spoilage can be adjusted through the budgeting process. And having said that, management typically tries to set their standards using ideal standards. However, sometimes setting ideal standards does have a negative impact on performance because employees see ideals as being unrealistic. We know in business that we will be faced with things like shortages, idle time, machine breakdowns, defects, you name it, right? Things happen in business. We know this. There are very few manufacturers on this planet that have perfection or close to perfection. One of those would be Nike. They use the Six Sigma approach to manufacturing. Six Sigma, if you're unfamiliar with the term, is where there's a defect in 1 in every 6 million units, which is pretty darn good, right? And in order to get Six Sigma, a lot of things need to happen. There's a lot of studies around that as well. It's very interesting. So that's ideal standards. Other types of standards include things like normal standards, which is more attainable. We call these currently attainable standards. These are standards that can be attained with reasonable effort. Reasonable effort. And most companies utilize what we call normal standards, or deemed normal by the company, based off of production difficulties and mistakes. Typically, we factor in a percentage of mistakes in the business. For example, if I manufacture a million units of a product, I might have a reasonable expectation that 10% out of that million may have some type of defect. Okay. That's a normal standard. Norms are typically set by industry, performance metrics, history, right? The list goes on. But when you hear the word normal, think reasonable, think within reach. Typically, these standards should be reviewed periodically to ensure that they reflect the current operating conditions. When operating conditions change, such as a decrease in labor force, a turn down in the economy, changes in consumer preferences, we need to make adjustments in the business. When our product becomes obsolete or becomes out of favor for whatever reason, we need to make adjustments to the product. So standards should be revisited when there's changes in prices, product designs, labor rates changing, manufacturing methods changing because of improved technologies, so forth and so on. So typically in business, we revisit our standards as frequently as we need to. Some businesses visit their standards once a year, others once a quarter, right? So sometimes once every few years, depends on the business and the nature of the business. There are, of course, criticisms of standards or standard costs. By implementing standards, it can be viewed as implementing limitations, which discourages improvements beyond the standard. You could say, oh, this is the standard grade for this course is a B. You set that standard. What is the motivation for the students to obtain the A, right? So that's why sometimes when we implement standards, it discourages others from going above the standard. Now, hopefully you all are shooting for the A, so don't just limit yourself based off of the standard B grade, right? The same concept applies in business. Standards can cause employees to lose sight of larger objectives of the organization by only setting their goals to the standard. So, yeah, standards can be harmful to some degree. How about budget performance? Earlier, I had mentioned, and I know that we talked about this in previous discussions, budget performance compared to actual performance. It's important that we identify our budgets and we compare our budgets to our actual performance throughout the year. As we're entering the actual data, we compare it to our budgeted performance. I have an example that we're going to use throughout this lecture, if you will. It's Western Rider. It's a blue jean manufacturer. I don't know if it's a real company. It might be. The standards for direct materials, direct labor, and factory overhead are set into two following components: standard price and standard quantity. Standard price and standard quantity. Standard cost per unit for direct materials, direct labor, and factory overhead is computed by taking the standard price times standard quantity. Standard price times standard quantity. Apologize for that. Let's fix that right quick. So budgeted performance is, we take standard price times standard quantity. That's the formula we're using. Okay, so in our example, we have standard cost for an extra large pair of blue jeans. For direct materials, the standard price is $5 per square yard. The standard quantity per pair of extra large blue jeans is 1.5 square yards, or 1.5 square yards. To find the standard cost for direct materials, we take the $5 per square yard times 1.5, which is the standard quantity, equals $7.50 of direct materials. The same concept applies with direct labor and factory overhead. $9 per hour of direct labor times 80 minutes per pair of blue jeans. Gets us this $7.20 or 0.8 hours. Isn't that fun? 0.8 hours. So I guess the conversion for that would be, let's see, 60 minutes in an hour, 0.8. We're talking about 40 minutes. Well, it's like 47 minutes, roughly. So you take your $9 per hour times the 47 minutes, or 0.8 hours, because factor out of 1, right? So that gets you $7.20 of direct labor. For factory overhead, the standard price for factory overhead is about $6 per hour. Factory overhead also about 0.8 hours per pair of extra large blue jeans, gets us a $4.80 for factory overhead. You add your direct materials, direct labor, factory overhead for each pair of extra large blue jeans to get us to a standard cost per pair of extra large blue jeans of $19.50. Okay, so now we know how much a pair of extra large blue jeans actually cost. The master budget is prepared based on the planned sales and production. As you know, a master budget consists of a bunch of smaller budgets from various departments. Budgeted costs for materials, purchases, direct labor, and factory overhead are determined by multiplying their standard cost by the planned level of production. So, as we saw earlier, to find the budget performance evaluation, we take standard price times standard quantity. Here we're able to take the standard price times standard quantity for direct materials, direct labor, factory overhead, add those together to get the standard cost per pair. In this case, $19.50. To determine the budgeted costs, we take the standard costs, we multiply that by the planned level of production. So in case $19.50 times planned level of production. We budget the budgeted costs, also known as standard costs, are compared to the actual costs throughout the year. When there's a difference between the actual cost and the standard cost, we call that a cost variance. There are favorable cost variances and unfavorable cost variances. And of course, you would make the assumption that a favorable cost variance means the actual cost is below the budgeted cost, actual below budget. That's favorable. Of course it is, because the company likes to save money. So if the actual cost is less than the standard cost, it is favorable. If the actual cost is greater than the standard cost, it is not favorable. That means we spent too much money. Right? That makes it unfavorable. In a favorable cost variance, the actual cost is less than the standard. And unfavorable, the actual cost is greater than the standard. How does all this look on a report? We have a report called the Budget Performance Report. This is a summary of actual costs in comparison to the standard costs and the differences between and the variance for the units produced. It's based on the actual production rather than the planned production. So the best way to think about it is actual and being compared to standard and looking at the difference, also known as the variance, based on the number of units produced. So here's our example. Remember, each pair of blue jeans cost $19.50 for extra large pair. Looking at our extra large pair of blue jeans that we have manufactured during the month of June, we produced 5,000 pairs of extra large blue jeans in the month of June. We accrued actual costs of direct labor, direct material, factory overhead of $101,050. Direct materials, $40,150. Direct labor, $38,500. Factory overhead, $22,400. You add those three together, they got total cost incurred of $101,050. So there's a couple of ways that we can analyze this information. One of the ways to figure out the true cost of each pair of blue jeans is to simply take the total cost and divide by the total jeans produced. So where's my calculator? There it is. So handy calculator here. We got 101,050 divided by 5,000 gets us a true cost of blue jean, each pair of blue jean being $20.21 per pair. We said that the going back, oh, sorry, wrong way. We said that the standard cost, which is the budgeted cost, is $19.50. Based off of our actual performance in the month of June, we can see that our actual cost per pair of blue jeans is $20.21. How did I get that? I took $101,050 divided by 5,000 pairs, getting us to an actual cost per extra large pair of blue jeans of $20.21. So it's a nice way of figuring out the actual cost. And of course, we can break this information down by looking at the variance. Okay, the variance. Remember that the variance here looks at the difference between the actual and standard. Actual is what it actually came in at for that month, for this month of June. The standard was the budgeted amount. Okay. 5,000 pairs, $7.50 per pair. The budget was $37,500. We actually came in at, for direct materials, $40,150, giving us a variance of $2,650. That is an unfavorable variance. Remember, it's unfavorable if the actual costs are higher than the standard cost. For labor, I came in at 38,500. My standard was 36,000. Unfavorable variance of 2,500. Remember, the variance is just the difference. Yeah. For factory overhead, actual came in at 22,400. The standard was 24,000. That is a favorable variance of 1,600. However, when I add up my variances, I came in over 3,550, which is an unfavorable variance for the month. So looks like the company's got a little bit of work to do. Everyone understands the concept of variance so far? Yes? Okay. Any questions so far? Everyone's good? Okay. Just making sure. I know you're all digesting the information. Okay. Let's talk about total manufacturing cost variance. Thank you, Alex. Okay. Let's talk about total manufacturing cost variance. It's the difference between the total standard and the total actual cost for the units produced. For control purposes, each product cost variance is separated into two additional variances. This is where it gets a little bit more complex. Okay. Think of it like, remember when we were talking about activity-based costing some time ago? We broke everything out by activity, and we talked about activity-based, right? This is similar in nature because we are breaking it down to the granular level. The same concept applies. To find total manufacturing cost variances, we break out direct materials, direct labor, and factory overhead with respect to their cost variances. The cost variances for direct materials are broken out by price and quantity variances. For labor, it's broken out by the rate and time. For factory overhead, the variance is broken out by controllable variance and fixed volume variance. Total direct materials variance is separated into quantity and price. Okay, so how do we find quantity, price? How do we find the variance? We take the actual price times the actual quantity gives us the actual direct materials cost. We compare that to the standard. The standard is standard price times standard quantity gets us the standard direct materials cost. To find the direct materials cost variance, we take the price difference, that's the difference between the actual and standard prices, plus the quantity difference, that's the difference between the actual quantity and the standard quantity. That gets us to the direct materials cost variance. So the actual and standard direct materials cost may be different because of a price difference or a quantity difference or both. It's usually both, by the way. In the real world, it's usually both. So that's quantity. Now let's talk about labor. Direct labor separated into rate variance and time variance. When we talk about rate, we're talking about dollars per hour. When we're talking about time, we're talking about the time actually used or the time the standard time or the actual time, right? To find direct labor cost variance, first we just find the actual direct labor cost, compare that to the standard labor cost to get the cost variance for labor. So the actual direct labor cost, we take the actual rate, actual dollars per hour, times the actual time used. We find the standard direct labor cost by taking the standard rate, that's the planned or the budgeted dollars per hour, times the standard time, the budgeted time for the manufacturing. Then, of course, we find the difference. To find the difference or the variance, we find the rate variance and we add that to the time variance. Rate variance is found by taking the actual rate plus the standard rate, or minus, depending on what it is. And the time variance, actual minus the standard. So actual minus standard, we get the direct labor cost variance by taking the rate variance plus the time variance. Remember, the word variance means difference, yeah? So the actual and standard direct labor cost may be different because of a difference in the rate or a difference in time, or both. It's usually both. It's very, very rare in business, that your budget equals your actual. Very rare. It happens for like fixed factory overhead stuff like rent or the mortgage or other fixed rates. Fixed rates meaning it doesn't change over time. That you can budget for, and budget will in fact oftentimes equal your actual. But for a lot of other elements, especially those that are variable, like direct materials, direct labor, factory overhead, which are, as we know, are all variable costs as we manufacture. Typically, when it's variable, we know that it's usually not going to be equal to our budget. It's very, very, our actual is usually not equal to the budget. It's very rare, especially when we talk about anything that's variable. That's how the real world works anyway. What about overhead? Total factory overhead variance is separated into controllable variance and a volume variance. As you know, factory overhead has fixed and variable elements. We use direct variance we use different variances than direct materials, direct labor, which are the variable costs. Direct materials and direct labor are separated into direct materials cost and direct labor cost variances for analysis and control purposes. So as we look at direct materials cost variance, we take the direct materials price variance and direct materials quantity variance, just like we talked about earlier. It's just kind of recapping, yeah. For the direct labor cost variance, we look at the direct labor rate variance and direct labor time variance. How many times can you say variance in one sentence? Right? Let's look back at our example, our extra large pair of blue jeans. During the month of June, we reported an unfavorable total direct materials variance of $2,650. Okay. That was by taking the actual cost, $40,150, minus the standard cost of $37,500 to get to an unfavorable direct materials cost variance of $2,650. Remember, it's unfavorable because the actual is greater than the standard. And just by breaking it down a little bit further, actual price times actual quantity Price times quantity, price times quantity. Gets us to direct materials. Standard price times standard quantity gets us to the standard materials. In the comparison, knowing that we have an unfavorable cost variance, we figure out why there is an unfavorable cost variance. Well, it looks like we paid an additional 50 cents per square yard of jean material. Why did that happen, you might be asking? Well, maybe our supplier charged us 50 cents more per square yard because of the change in economic conditions or the change in supply, right? And then looking at the quantity used. Apparently we used 200 square yards less of material. We planned on 7,500 square yards. We only used 7,300 square yards. Okay. These two differences from the standard are reported and analyzed in the price variance of direct materials and quantity variance. So in other words, we still came in over on our direct materials, but it wasn't because of how much material we actually used. It was because of the price increase on the materials received, right? And so that helps us to identify the reason for the variance. It's always important that we understand in management why a cost increased, what caused that increase. So to find the direct materials price variance, we take actual price minus the standard price. Do that first. We multiply that by the actual quantity used. Okay, so looking back at I went a little too far ahead. Looking back at what we have here, the actual price was $5.50. The standard price was $5, difference of 50 cents. 50 cents times the actual quantity. We produced, how many? 5,000, right? So 50 cents times 5,000 gets you the direct materials price variance. Remember, the word variance means difference. If the actual price per unit exceeds the standard price per unit, it's unfavorable. Remember, anytime actual is higher than the standard, it's unfavorable. Yeah, it means we spent too much. Goodness. If the actual price per unit is less than the standard, it's favorable. It means we save some money. All right, so looking at the difference, 50 cents difference. Back to our example. 50 cents difference, 550 minus 5 is 50 cents, times 7,300 square yards actually used, direct materials, is $3,650 of an unfavorable variance. That means we overspent in materials by $3,650. Happens from time to time. Actually, it happens a lot. Okay. Direct materials quantity variance. So we looked at the price variance just now. Now let's take a look at the quantity variance. So instead of price, just substitute for quantity and then multiply by price. So we have actual quantity minus standard quantity times the standard price. If the actual quantity exceeds the standard, it's unfavorable. Remember, actual greater than standard, unfavorable. If the opposite is favorable, where the actual comes in under the standard. So in this case, it's favorable. For the actual quantity used, we actually used 7,300 square yards. We planned on or budgeted for the standard quantity of 7,500 square yards. So 7,300 minus 7,500 is a negative 200 square yards times $5 per square yard of the standard price equals $1,000 favorable variance. So minus $1,000 favorable variance. So let's see how we got there. Let's put it all together. The actual cost, we came in at $40,150. How we got there, 7,300 square yards used at $5.50 per square yard. In terms of the standard quantity, we came in, we planned on 36,500, gives us a difference of 3,650, unfavorable, because we're over in materials, in terms of materials price. In terms of materials quantity, we have a favorable difference of 1,000. We took the standard minus the actual minus the standard, came in at 1,000 under, which is pretty good. Give us a total variance of 2,650. We take our price variance minus our quantity variance to get us to 2,650 unfavorable. Everyone sees how we got there? That makes sense, right? This is just a nice graphical representation of how we got there. Okay, you're all still good, right? Not sleeping on me, are you? I know how exciting this is. Okay, let's keep rocking and rolling. So that is standard costs. Any questions on standard costs before we jump into capital investment, also known as capital budgeting? Good? Okay. I trust y'all. Capital budgeting, capital investment. What is capital budgeting, you might be asking? Capital budgeting is the process by which management plans, executes, and controls investments in fixed assets. As you recall, fixed assets are property, plant, and equipment. It could also be other assets that are long-lived. For example, it could also be intangible assets like patents, trademarks, goodwill. These are all intangible fixed assets. Fixed assets also include property, plant, and equipment. That's the typical. Most businesses, they establish what's called a capital budget. This is a plan used to make what they call capital improvements. Is another line item. And you probably have seen this on your 10K reports at some point. Capital improvements are plans to improve property, plant, and equipment in the future, whether that be investing in new equipment, new buildings, or new property, right? And we perform this thing called a capital investment analysis, capital budget. The process used is more finance than accounting. This is more finance than accounting, okay? The things I'm about to show you. And you'll see some of this again in week 8, but it's a part of week 7 because we talk about capital budgeting. With capital budgeting, we perform a series of computations using either present value or a method that does not use present value. Present value is the value of money today. Value of money today. To find the value of money today, we use this thing called a discount method or internal rate method. And we'll talk a little bit about all of these things. Present value, looking at methods that do not use present value, we talk about the average rate of return or the cash payback methods. Ones that use present value, we look at net present value or the internal rate of return. All of these methods are used when it comes to identifying a capital budget. We call these things the time value of money. Time value of money. Recognizes that $1 today is worth more than $1 tomorrow because $1 today can earn interest. So if you think about it this way, I invest $1 into a bank account that has a 10% interest rate per year. Okay. Based off of that information, my $1 will earn 10 cents during the year. I leave $1.10 in the bank. That $1.10 then earns an additional 10%, yielding $1.24 in year two. Year two, you leave the $1.24 in the bank. It yields another 10%. Your $1.24 turns into $1.48 at the end of year three, so forth and so on. This is the time value of money concept, where we know that $1 invested today has the power to earn interest. Methods that you also call that present value. We'll talk about present value. Methods that do not use present value are often used in evaluating capital investment proposals that have relative short useful lives. Typically, I use the cash payback period. We'll talk about that. And sometimes we use cash flows, a series of cash flows as well. Okay, let's talk about the first method. It's called rate of return. Rate of return is a concept that we use to identify, how do I want to say this? The average income over the life of an investment. To calculate the rate of return, we take the average annual income divided by average investment. How do we find average investment, you might be asking? How do we find average annual income? Average annual income, it's the average, right? So if we're looking at an average of X number of years, you add up your annual income for a series of years and divide by that number of years. That gives you your average annual income. To find an average investment is essentially identified by using straight line depreciation. It's the same concept. Average investment, we take the initial cost plus residual value divided by 2. Why divide by 2? That's how you get the average. Okay. Let's assume that our company is looking to purchase a new piece of machinery. To find the average rate of return, we take the data provided. Cost of the new machine, $500,000. Residual value, 0. Total expected income from the machine, that's called average annual income. Divided by the 4 years of useful life, or expected to last 4 years, I should say. Here's how it works. Initial cost plus residual value, 500,000 plus 0 divided by 2 gets us to 250,000. About the find the average rate of return, average annual income is 50,000. Why 50,000? You might be asking. Well, if it's 200,000 expected total income divided by the useful life, that's 50,000 per year, average. Yep. Average annual income, 50,000 divided by average investment, 250. Our average rate of return will be 20%. I think that's pretty favorable. 20% should be compared to the minimum rate of return set by management. Management will say, oh, well, in order for us to invest in this machine, we should be at least getting 10% return on our investment. 10% is relatively arbitrary number. It's set by management. Typically, they want to at least get 10% back. That's pretty standard. But it is still an arbitrary number. It's something that's set by management. So they typically look at, they'll compare the two rates. If the rate is above the minimum, then typically management will accept the proposal to purchase that type of machine. A couple of advantages of this method. It's very easy to compute. It includes the entire amount of income earned over the life of the proposal. And it emphasizes accounting income, which is typically used by investors, creditors, and management. Disadvantages is it is not directly considered, does not directly consider the expected cash flows from the proposal, and it does not directly consider the time of the expected cash flows. We'll talk about those two methods here shortly. As you recall from earlier conversations, cash flow, net cash flow, that's cash coming into the business minus cash leaving the business equals net cash flow. Cash inflow minus cash outflow equals net cash flow. And that does not, this method does not consider that. Also does not consider the time of the expected cash flows. So that's one of the disadvantages. Speaking of cash flows, let's talk about this thing called cash payback method. Cash payback is the expected time between the date of the investment and the recovery of the initial investment. So if I spent X number of dollars on a machine, how long will it take me to recoup that initial cost? That's what cash payback period is. It tells us you can think of it like break even. We've talked about that concept, break even. Cash payback period is very similar in nature to the break even point. To calculate the cash payback period, we take the initial cost divided by the annual net cash inflow. Okay. In our example, we're looking to purchase a piece of machinery. The cost of the new machine is $200,000. Cash revenue from the machine per year is $50,000. Expenses of the machine per year, including depreciation, is $30,000. Depreciation per year is $20,000. Okay. To simplify, we take our cash revenue from the machine minus the expenses equals the net cash inflow from the machine for $40,000 per year. We have other expenses such as depreciation totaling $30,000 minus depreciation of 20,000 gets us to the cash expenses of the machine of 10. That's how we found the cash expense of the machine. We know in accounting that depreciation is not cash, right? We know that. We consider depreciation as an expense, but not a cash expense. Right? So revenue, the standard expenses of the machine being 30,000. To acknowledge those expenses, taking 30,000 minus depreciation expense, the total cash expense is 10,000. So to find the cash payback period, we take the initial investment of the machine, 200,000, divided by the annual net cash inflow of 40,000. Our cash payback period for this machine is 5 years. In other words, it'll take me 5 years to recover the initial investment of the machine. You can do similar types of things for like your personal vehicle, your house, things like that. It's interesting. It's kind of fun, actually. Okay, so in that example, our cash inflows equaled 40,000 per year. Remember, when they're talking about net cash inflows. In other words, net cash flow, right? Net cash flow, cash coming into the business minus cash going out of the business. In our example, the revenue coming in and the expenses going out, right? When the annual net cash inflows are not equal, which oftentimes they're not, we typically don't make the same amount of net cash flow per year. It usually varies every year. When the annual net cash flows are not equal, the cash payback period is determined by adding the annual net cash inflows until a cumulative total equals the initial cost of the proposed investment. So looking at our example, let's assume that we have an investment initial cost of 400,000. The annual and cumulative net cash flows inflows over the 6-year period. You can see our net cash flows vary. Cumulative net cash flows we add each year to its respective year. You can see that at the end of year 4, we reach 400,000, which is the cost of the initial investment. So the cash payback period is therefore 4 years. Now you could even break this down by month, which is what a lot of companies actually do. You break it down, to the exact month of when you hit break even or cash payback period, which is what typically businesses do. But we don't get that technical, right? At least at this level. For those of you who are in finance, you will be seeing this a lot. For those of you who are in accounting, you'll be seeing this in future courses. For those of you in management, you won't be seeing it that much. Just give you an idea that this stuff will come up again at some point in your degree program. Cumulative net cash flow at the end of year 4 equals the cost of the initial investment we just saw. A couple of good things about cash payback method. Short cash payback method is desirable. Yes, obviously. I like to recoup my initial investment as soon as humanly possible. Definitely. Sooner the cash is recovered, the sooner that cash can be reinvested for other projects. There's less of a chance of loss from changing economic business conditions using this method, and any debt used to purchase the investment can be repaid quickly, ideally. Advantages: it's simple to use and simple to understand. It analyzes cash flows. Those are good things. Not so good things about using this method: ignores cash flows occurring after the payback period. After I reach year 4, I don't care what happens in year 5 and year 6. I already recovered my investment in year 4. So that's kind of a disadvantage. It does not use present value concepts in valuing the cash flows during the different periods. So that's also kind of a negative. And that, my friends, is the end of this version of capital budgeting. Are there any comments, questions, concerns, anything that you would have hoped that we would have covered today? We're good? And look at that, we ended right on time. That's pretty cool. Okay. If you think of anything, if you're like, oh, I wish we would have covered this, please let me know. You can feel free to email me, call me, put something in the classroom, in the discussion area. I'll be happy to answer your questions. Absolutely. Other than that, as a friendly reminder, what do we have going on this week? This is the busiest week of the course. We have a discussion on make or buy using incremental analysis. We have our final 10K report is due. Our final PowerPoint is due. We have a homework assignment. And, oh my goodness, we have exam 3. And we have a week 7 report out. So my recommendation, as I mentioned earlier, is please make sure that you complete homework 7 before taking exam 3. You will see very similar component questions covering this week's material on exam 3. So I recommend that you wait until the end of the week to complete exam 3. Comments, questions, concerns? Anything at all? We're good? Okay. Hearing or seeing no comments, questions, or concerns, I want to, again, thank you so much for joining me. I really do appreciate these sessions. I hope you appreciate them as well. If you ever need anything, think of anything, just drop me a line. I'll be happy to get back to you as soon as I can. Also, I'm in the process of grading from last week. I have already graded your homework assignments. I have not yet graded the discussions or the reports. I will get to those over the next few days. I appreciate your patience in that process. It's a lot. And then next week, I'll probably be a little bit quicker because week 7 is a very heavy week. So I try to grade as much as I can during the week just to make life a little bit easier for all of us. So again, thank you so much for everything. I appreciate all of you joining me. And if you think of anything, just let me know. I'm here for you. So thank you so much. Have a great rest of your day, evening, morning, wherever you may be. And we'll see you again next time. Stay safe. Wash your hands. Do the right things. Thank you so much.
Thank you.
Thank you.
Thank you, Dr. B.
Thank you. I appreciate all of you. Take care. Bye-bye.